Hi, I'm Pinto Basto, VP and Portfolio Manager at Westwood International Advisors, the manager of the Global Dividend Fund. Where we're coming from with Europe is they've been essentially the global laggard. US has developed nicely from an economic point of view and from a market point of view. Emerging markets have certainly also been strong. And Europe has really been the piece of the puzzle that has yet to fall into place. The financial system is about to go through what we all hope to be one of the last regulatory overviews in two ways. One is the asset quality review, where all banks across Europe will be reviewed in a similar fashion. The end result is a judgment as to whether they have sufficient capital or not. Secondly, a stress test of the financial banks and their loan portfolio. From there, I think those two will enable the economy in general to then refocus on growth. We do two things differently. Firstly, we look at all companies through an EVA lens, so economic value add. We look for companies that are going to cover the cost of capital. We think that's important because it provides, it creates solid business franchises and robust business models that can sustain both good and bad times. That's number one. Number two, we look at the world in a truly global context. So we don't just look at the world on a regional basis, on a developed versus EM basis. We look at it at a developed plus EM basis. What I'm trying to do is I'm trying to balance companies that have attractive dividends and maybe are mid to single digit growers from a business point of view, so top line or bottom line, with companies that maybe have a lower dividend yield but are much significantly faster growers. So they'll grow maybe mid-teens to high teens, that sort of thing. I'm trying to balance the two to create a portfolio that has overall attractive growth within the holdings that it has, which in turn translates into attractive dividend growth as well as attractive dividends to begin with. And so when you put it all together, it's a balance of returning capital and income streams to shareholders while also being able to grow the underlying business. We want companies that are covering their cost of capital, that have a history and will continue to do so and create what's called economic value add. What that does is it translates into companies that typically have attractive free cash flow. And free cash flow, really, at the end of the day, you can do two things with it. You can reinvest it in the business or you can pay it back to shareholders. What we're looking to do is essentially, as long as companies satisfy the condition of creating economic value by covering their cost of capital, they're attractively priced, and they're a business that complements the portfolio. We want companies that have either attractive dividend yields with let's call it a reasonable growth rate, so mid to single digit growth rates, or we want companies that are going to have a higher growth rate and maybe a slightly lower dividend yield. So I'm trying to balance essentially a mix of companies that have attractive yields with also companies that have attractive growth. And so overall, the portfolio is a balanced portfolio of growth and attractive yield that investors can benefit from. We have global perspectives. We think that the culture and that background that we bring to the table is advantageous relative to, certainly advantageous relative to an ETF, but also to some of our competitors. Secondly, we think globally. So we think emerging and developed, not just developed or not just emerging. So this is a portfolio that will benefit from both bases of knowledge, from looking at the world in that basis, and therefore we pick truly the best ideas possible in the portfolio for long-term total shareholder return that is both capital appreciation and dividend streams. You're not going to get that with a dividend ETF. You're not going to get that flexibility in terms of something that is predominantly North American based and has 20% or 15% of other parts of the world. What we bring is diversification and a global perspective and global know-how. One of the other things that you're going to get with us is that we don't overpay for things, right? So, whereas an ETF is blind to valuation, we take that into consideration. So we try to get securities or companies that create economic value, but not overpay for it. And so we protect ourselves on the price side, but we also ensure we have a good business model.